I'm introducing Jacobus Lacocque, our macro strategist and PM on the multi-asset and fixed income portfolios this morning. He's been with Fairtree since 2011. He previously worked at Goldman Sachs in London. He's a CFA charter holder and he's got an honours degree in economics. A lesser known fact about Jacobus is that he actually reigns from the Northern Cape, a small town called Kennard. Given the market's rapid moves in 2025, especially around precious metals in South Africa and emerging markets dominating, what do you see and what are you looking forward to in 2026 from a macro perspective, Jacobus?
Yeah, thanks, Stefan, and thanks for that warm introduction. So I think looking at 2026, first of all, we are quite constructive and we are excited about the opportunity set for the year. 25 has been a good year for many investors, and 2026 we think can produce also good returns. It may not be the same names, the same sectors, countries, or asset classes, so we have to be nimble in this environment. But let me just break this down. I'm constructive because I think the starting point is a lot better. When we look at economic conditions, we've seen how interest rates have come down as central banks have cut rates. We've seen how the US dollar has weakened and also how the oil prices come down. And this is all good for the consumer and good for producers. Now, with that, we also think that inflation is moderating. From a high level, it's still coming down. And with inflation coming down as a result of first, the tariffs hasn't had the big impact that we feared it was going to have. China is producing. They had a supply response. They're producing goods. The excess capacity is going into the rest of the world. It's driving down prices, and we're benefiting from that. And also the cyclical tailwinds to inflation, like shelter inflation and wages, is also starting to slow. So we think inflation is coming down, allowing central banks to continue to cut rates. So for the Fed, maybe another 2 to 3 times, and that will be supportive of risky assets. Risky assets, we mean like equities, commodities, emerging market assets. And so we think that's constructive. But I also want to just caution that we also are a little bit on the defense and take a bit of caution when we look at the geopolitical environment. Just more recently, we've seen how the US is trying to take territory and influence trade outside of the US. There's another US government shutdown looming in the next few days, potentially. And even the US Federal Reserve has been under attack from the Trump administration, and people are concerned about the Fed's independence. So this will create policy uncertainty in this environment, and we have to be, take some caution on that. But exciting opportunity set. The volatility will create more opportunities. One has to be nimble and active in this environment.
Thank you, Jacobus. Given what Jacobus has said, Chantal joins us as head of SA Equity Research, also a portfolio manager on the Fairtree Equity Fund. She's been with Fairtree since 2017. Her prior experience is on the sell side. She also started her career at Deloitte. She holds an honours degree in management accounting and is also a chartered global management accountant. Other than the gift of the gab, she's got the ability to actually hold control of a spinning class. As a spinning captain, what is your view on Mr. Trump and his way of taking control of the global leadership by taking the Venezuelan leader in custody? What is your biggest fear and hope for 2026, given his revolutionary moves?
Thanks, Stefan. Thanks for the introduction. I think what's interesting is the 2 words you pointed or touched on there, hope and fear. They're the 2 most powerful, most primal emotions of humankind that really drive our behavior. And it does feel as though we're operating in a world like that. With that comes a lot of volatility and, again, a lot of opportunity. Sometimes I think we give the man a little bit too much airtime, and I do think it's not just the man, and I do think the system is greater than the man. I think it's the current administration that's driving this. And I think we have to appreciate that we are operating in a different world. So we're operating in a world where the global rule has broken down somewhat. And we saw Russia test this. They were the litmus test for this when they invaded Ukraine, and very little was actually done. Then the US made a move with Venezuela, as you pointed out. and very little was done. So we're operating now in a multipolar world where the hegemon, which has been the US for decades and decades post a Cold War, is suddenly being questioned. So you have the debasement trade coming through. Yes, inflation has come down considerably, as Koos pointed out, but I think you're going to have a land grab now for commodities. So it's not going to be countries what they need, but making sure they control things. The US going into Venezuela, for example, is them trying to control the supply of oil. It's not that they need the oil. In that instance, I think that there's a structural support for certain commodities going forward, which makes it really exciting for us. I think that precious metals continues to do well, and that's where I get quite excited about the market, especially the JSE. There's a fair amount of precious metal and base metal access that you can get. But yes, we're operating in uncertain times, and I think that's the important part, though, is as an equity manager, that often presents a lot of opportunities, especially very explosive alpha opportunities.
Thank you, Chantal. I think with that uncertainty, great man to introduce is Cornelius Zeeman, the head of Global Equity and Emerging Market. He thrives on risk. I think he's got probably one of the best work ethic and work rate that I've ever seen in my career. He's so incredible in terms of his time management. He's able to manage the whole Transnet rail scheduling system better than the transport minister. Name your biggest surprise of 2025, Cornelius, from a single stock perspective, a company that totally was underestimated by most of the market.
What a low bar you're using comparing me with Transnet, but I appreciate the sentiment. The biggest surprise, I think, is two sides of the same coin. It was the strength of the semiconductor names. The index is up 40%. And memory names like Micron was up 200 to 40% and up another 35 this year already. And the other side of the coin was the AI losers, the software names, because everyone is now pricing them as if we're going to code all the software ourselves. We're a bit skeptical about whether that will really play out. And these companies have actually continued growing earnings by 10-20%. So they've derated by 40%. So I think the biggest surprise was the extent of the development of the AI technology and also how the market is aggressively pricing in the winners and the losers. And I need to say potential winners and losers because only time will tell. And I think the biggest learning we took out of it is we really need to stay on top of the technology. So we're obviously embracing third-party service providers like AlphaSense and Visible Alpha, and we're using the LLMs in our workflow. But we've also now started using Claude Code to see what can we do in the software space to identify the risks for some of our investments, but also incorporate that into our workflow. So one of my junior analysts that joined the team this year, he coded an Outlook calendar where you can manage workflow like a Monday.com within an hour yesterday morning. So it's really impressive what the technology can do these days. And I think it'll have a major influence on the markets. And you have to be very open-minded in this space.
That is definitely an interesting factor that artificial intelligence is bringing to the workplace. And I think as an asset manager, this brings opportunity. South African markets sit at the intersection of a gradually improving domestic backdrop and a still uncertain global environment. There's moderating inflation, prospect of easier monetary policy, and tentative progress on key structural constraints that offer grounds for cautious optimism. Even as global growth slows down and volatility remains elevated, the global investment landscape is shaped by structural forces, evolving policy dynamics, artificial intelligence reshaping economic behavior, enabling output to grow even as labor demands softens. Valuation dispersions across regions remains wide, and policy developments like the Federal Reserve leadership, the Chinese stimulus, as Jacobus has already alluded to, adds a lot of uncertainty, but also opportunity. Shareholder reforms in emerging markets and a softer US dollar in 2025 created a more supportive condition outside of the US. Jacobus, against this backdrop, what do you see as the key local and global macro themes shaping the year ahead?
Yeah, Stefan, I think there's, on the global side, maybe three themes. And it's potentially not just for this year, it's for the next maybe 2 to 3 years. And the first one is that central banks are cutting interest rates, but we are entering the latest stage of this cutting cycle. So we are at the last leg of the cutting cycle. If you look at, central banks, they've cut 200 basis points on average, roughly the core central banks since 2024. We think there's another 50 to 75 basis points of cuts that can come through. And they've cut because inflation has come down. It's very different this cycle than prior cycles, where it was a recession that got them to aggressively cut rates. This time it's because rates were high, inflation has come down, so there is the scope for central banks to act and bring rates down. Now, this is important because it means that central banks will cut rates to the neutral level, not too below, to stimulate growth again, but to neutral, which means that we'll probably get to a higher level of rates than in prior cycles. So for the US, we think it's around about 3%, another 2 to 3 cuts to 3%. ECB, they maybe have to cut again, once, maybe twice, because of weak growth dynamics and competition from China. The Bank of England may have to cut a little bit more, maybe 2, 3 times again. Other central banks outside of those three, other core central banks, if you look at market pricing, the market is starting to price in hikes for some of them. You think about Australia, New Zealand, and Canada. So I think the debate this year is going to start to evolve to go from we're ending the cutting cycle, and how quick is the next hiking cycle going to come through? Think about it this way. We are sitting in the US with a fairly robust consumer. We are cutting rates because inflation allows us to do so. This year, fiscal policy is going to be fairly constructive for growth, specifically in the first half of this year. So you're going to get a potential environment where the US can again maybe overheat or start to re-emerge and push inflation higher again. This is not an immediate risk, but I'm talking about maybe a few quarters out, next year, 18 months out. But the debate will start to take hold of markets sometime this year. This against the backdrop that there's going to be a new Fed chair. Jay Powell is going to retire as the chair in May, and the new Fed chair, some of the markets are concerned that it could be a political appointment. Now, will the new Fed chair be emboldened to hike rates 18 months down the line, if indeed we're starting to see a re-emergence of inflation? Really fascinating dynamics that could start to play out over the next 24 months. So that's the first theme. Second theme is that we are seeing an increased fragmentation of geopolitical tension in the world. We look at not just the fragmentation between the superpowers, meaning the global West and the global South, but also within the geopolitical Western Hemisphere, we are seeing more divisions opening up. There's concerns about the cohesion within NATO. Mark Carney delivered a speech at the recent Davos meeting stating that the middle powers, UK, Australia, and some of the European countries, may have to stand together against the superpower rivalry, unchecked superpower rivalry that's taking shape at the moment. And so I think these dynamics, with the fact that we see territory and trade and energy flows being disrupted by this fragmentation as well, it could lead to a couple of things. The one is that countries are putting national security above economic efficiency, somewhat inflationary over the long term, I would say. More countries are starting to hoard the commodities for strategic purposes. Again, also maybe slightly inflationary over the long term, and pushing up metal prices like we've seen. It's happening at the moment. And so we think these dynamics could play out positively for certain markets, but it is leading to policy uncertainty and is leading to the fact that the traditional safe havens, US dollar and US treasuries, are not doing the work that they used to do. And we need to look at alternative safe havens. And precious metals has been, in that regard, probably the best safe haven thus far. Interestingly, there's more central banks or central bank reserves. There's more gold central bank reserves at the moment than US Treasury reserves. So you can definitely see that shift taking place. The third theme is that China does need to reflate. They've been in deflation for the last 2.5 years. Their nominal growth is barely 4%, lower than that of the US. It means that that consumers are delaying their purchase decision because they can get things cheaper tomorrow than today, and that puts a lot of pressure on the growth dynamics of China. Now, they've reacted in a way by trying to push product by the supply side, but that's only meant that they've pushed prices further down and now exporting that to the rest of the world. And that has benefited the rest of the world's consumers. It hasn't benefited their manufacturing side. If you think about Europe, they've faced immense competition from the likes of China, and that's really, hurt them. So I think this power play is happening at that level. So China needs to reflate the economy by bringing in domestic demand, increasing domestic demand. And one way of doing so, and I think we have to wait for this, is that the housing market will need to turn around. And this could be a surprise for the next 12, 24 months, that the housing market starts to turn around and that you get confidence coming back into the US, into the Chinese consumer, and they're performing better. So I think that theme is one that we need to watch. Then the last one, and I would say this is a local theme, it is the reform momentum that is building up at the moment, that continues. If you look at, and I think there was a study done in 2019 by the IMF that shows across 41 countries have done this research and look at reforms and the impact that would have on growth. And it typically takes 3 years before you start to see the impact on economic growth. And it takes 6 years before that impact starts to peak. So we have to be patient. And I think we're starting to see some of the numbers improving. If you think about the network economies, electricity availability is now at above 70%. December 2024, it was 55%. Tonnage, so rail freight that's going through the lines for the last year, it looks to be 170 million tons, roughly on target for the year. It came all the way from 150 tons just 2 years ago. So we are starting to see improvements. Tourism, that's peaking. That is reaching new record highs. The ports are operating a lot better. Container handling for some of the weeks last year reached record highs. So through all of this, we see that the reform dynamics is picking up. Consumers are getting a little bit more optimistic. Businesses are getting a bit more optimistic. We think we are, I think, especially excited about the consumer. They've got good balance sheets, but on top of that, fuel prices are coming down. In 2 weeks' time or next week, you'll see another 60 cents down on your fuel price. Inflation is low at around 3%, low 3%. SARB is going to cut, we think, another 2-3 times, potentially to 6%, even lower potentially. So we are more optimistic on cuts in the market. And then we see also there's been a very strong wealth effect, which people hasn't realized yet. If you think about this traditional SA equity bond portfolio consisting out of SA assets, last year, they would have returned 36%, the best in the last 2 decades. So people, I think, certainly the high income consumer are sitting on a positive wealth effect that can also still play a role. So we are optimistic. Yes, there are some risks. So the leadership changes within the DA and the ANC next year and this year and next year, that could still have an impact on the GNU and how people think about reforms. And also our foreign policy has been clumsy, and that could potentially still hurt investor confidence and confidence amongst our trading partners. So there are some risks, but I think those are the themes that we need to watch from a more macro perspective.
Thank you, Jacobus. I think let's move a bit more to global equities and just your view around the supportive environment that falling inflation and easier monetary policy has given global equities and equities local, and also obviously the AI sentiment. There's some themes that actually emerged. Can you maybe just describe the broad market themes for the market structure globally that you see for 2026?
So Broadly, we see stable growth, but that growth, I think, is more certain in emerging markets than developed markets. So we actually favor emerging markets. They are under-owned. Their valuations are a bit more attractive. They will benefit from a weaker dollar, which we think will play out still. And also, due to the higher commodity prices, a lot of these countries are commodity producing. So we like EM. South Africa kind of fits in that space as well. It benefits from the same themes. And we are actually seeing foreign flows starting to come into the country. Last year, it was bonds. Foreigners bought our bonds. And this year, in the first few weeks of this year, we are starting to see some of that flowing into the equity space. So, in a similar vein, we see that US exceptionalism is still exceptional in certain pockets, but that exceptionalism is fading. Now the countries are starting to attract more capital and becoming more attractive. So I think that theme remains, that it's an ex-US play. It's an emerging market play relative to developed markets. It's good for commodities. We think with that, last year has been a year of concentration within equity indices, whether you look at the US or South Africa. That I think is going to start to broaden out this year. We get and also the leadership may change. So within South Africa, some of the leadership may go to the local names, away from the resources. The resources will still continue to do well, but I think there will be a bigger push from the local names to do well this year.
Thank you, Jacobus. Cornelius, linking to that, given this shift, what are your expectations from global equity and specifically US equity returns in 2026?
We are quite constructive on equity returns. Jacobus has laid out the economic environment of strong growth. Fiscal and monetary policy will help the consumer. The big beautiful bill will stimulate a lot of investment. We're seeing aggressive investment in the AI build out, specifically data centers and everything that comes with that, the infrastructure, electricity that you need. So, and companies are becoming more profitable. So we are on track for a year of potentially low double-digit earnings growth. And the valuation starting point globally is in line with 5, 7, 10-year averages. The US is still slightly above their long-term averages, so maybe there's a risk of their market derating slightly, but I think we're on track for high single-digit dollar returns, and then you need to take a view on the currency to determine what that means for you in rands. The chart shows the dominance of US equity markets in global indices. So we are roughly at 65% in MSCI ACWI and more than 70% in MSCI World. And last year was the first year in a long time that we've seen the US underperforming. And we agree with Jacobus' sentiment that the rest of the world will probably continue to outperform this year, specifically emerging markets where we're constructive. And in terms of market concentration, which he touched on, last year was the third year of only 30% of companies in the S&P outperforming the index. And you have to go all the way back to the dot-com bubble for such a narrow market. And it's our base case that we'll see some change in leadership and a broadening out of performance, which is, of course, very conducive environment for active managers. It's been a tough 3 years for active managers.
Thank you, Cornelius. Linking to that, what is your thoughts on the possibility of an artificial intelligence bubble? And should investors actually be nervous about investing in the US?
We are probably in some kind of bubble. If you look at the investment that's taking place, the hyperscaler names like Amazon, Meta, Microsoft, they are using all their free cash flow to invest. And we are seeing some of the companies like Oracle and Meta starting to use some debt to finance the investment. And if you look at investment as percentage of GDP, we are now reaching the levels of dot-com. But with the dot-com build out, we stayed at those levels for 10 years. So it's not like we can expect a correction imminently. And if you actually, so if you look at the earnings growth for these companies, very impressive, but the cash flows have stalled over the last 4 years. But if you look at the big tech names, most of them started in the low 30s price earnings ratio. If you think about Microsoft, Nvidia, Meta, Google, and they've actually derated to closer to 25 times. Meta is trading in the teens. So we actually think the valuations are very reasonable. They are trading in line with the rest of the market while giving you much faster growth. So we've actually moved into those names over the last bit, but there are definitely pockets of the market that's very frothy, where people are placing peak multiples on potentially peak earnings, and we are more talking about the equipment names. So you have to tread carefully, but I'm not that worried about big tech being in a bubble and the US market collapsing.
Thank you, Cornelius. I think linking to that, how has your active positioning and as an active manager helped you actually to capture some alpha for our clients using your multi-factor approach?
So we were underweight the US tech names at the start of last year, but then we had this amazing buying opportunity around Liberation Day, or some people call it Liquidation Day. And we aggressively started buying into US tech. And in 2026, we are actually now overweight these names. And we've used some of our overweight in emerging market tech names, specifically the Chinese e-commerce names, as funders. So we were very overweight those names. Share prices were very depressed, and we were seeing benefits from stimulus, consumer stimulus coming through in China. And we had the announcement of DeepSeek, and a lot of the companies benefit, but we are actually seeing very fierce competition under those names like Meituan, JD.com, Alibaba. Fortunately for SA investors, Tencent's not involved in that, but specifically in the food delivery space and quick commerce space, they are now at break-even or even loss-making levels in their core businesses. And the share prices have run nicely in the first 6 months last year, so we took profits on those names and recycled it into US tech names.
Thank you, Cornelius. Let's take this a bit more to the risk side of managing funds. How are you protecting your funds against the potential pullback?
So the global equity and the emerging market funds are highly diversified. We run with 100 to 80 names. So a lot of diversification that you get. But then our multi-factor approach means we are always overweight value, as well as quality and growth and momentum. And when you look at the price earnings ratios of our fund, for the global equity fund, we are sitting at roughly 17 times or so on a current basis, which is 5 points cheaper than MSCI World, and the emerging market fund is barely above 10 times. So being positioned in lower valued companies will protect us against any potential sell-off. And then we are also overweight quality. So if you look at the return on equity of the global equity fund holdings on a weighted basis, we are in the high 20s, which is almost 10% higher than MSCI ACWI. So we think it's important in this fast-changing environment to be positioned in companies that have pricing power and the ability to adapt, companies that don't have a lot of leverage, etc. So we think being overweight value, overweight quality, highly diversified, that really sets up the fund to navigate any potential market conditions changing rapidly.
Thank you, Cornelius. That sounds like a very sensible and prudent approach. 2025, Chantal, has been all about uncertainty and precious metals dominating. Do you think this can continue into 2026, or have we hit the ceiling for precious metal pricing?
Stefan, if I had a rand for every time a client asked me what's the price of gold is going to be this year, I'd be really rich, even in rand or dollar terms. But it's a question on everyone's lips, and I often flip it on its head and say, don't ask how high it can go, ask what's driving it and what do you think is going to stop it. So the graph that you're looking at on your screen right now, you're just seeing the correlation between uncertainty and gold. And to Cornelius's and Chris's points earlier about Liberation Day or Liquidation Day, what happened on that day is we had a massive risk-off event. When the market looked out into the world and said, I can't forecast, I can't see, it's as clear as mud. I'm going to take my money out of risky assets, predominantly being equities, and pivot it into safe havens, which historically has been gold, US treasuries, and the dollar. What happened on Liquidation Liberation Day is that the dollar weakened, yields actually went up, meaning that people were dumping their bonds, and we saw strength in gold. So since then, the world has started to ask the question, is the dollar really worth it? And on that day, when the US became a source of capital as opposed to a destination for capital, it's continued with this momentum. So you've also seen a huge rise in precious metals such as platinum and silver more recently. I saw silver this morning reached $110 per ounce. So it's going quite fast. Do I think it could go higher from here? Yes. How much higher? I'm not quite sure. So we never ask ourselves the question when we're looking at these companies as to at what price of gold or what price of platinum do I sell out? We plug spots into our models and we see what type of free and available cash these companies are spitting out. If you look at the slide that is in front of you right now, I've just divvied up on the left-hand side all your PGM counters. So that's your platinum group metals, and then your gold counters on the right. The blue bar is where spot is right now, where gold, platinum, palladium, rhodium is trading at. And then if we nudge it up by 20%, or if we take it down by 10%. What you can see here is that there's a lot more upside risk in the PGM basket versus the gold basket. From a downside perspective, yes, gold is protected, but if you want explosive type of alpha from here, from this point onwards, you're possibly going to get it more in the PGM space, and that's because they hold, specifically platinum, a precious metal characteristic, as well as an industrial application. So in the next slide, if I actually put that theory into practice, the orange line there being gold and the blue line there being platinum, for the orange line to go 20% up, it's a bit of a stretch. It's not impossible, but the blue line could continue to go up. So we have a preference right now for PGMs over gold. Another complexity we're facing in our market is that because gold has done well, not only over the last year, but the last 4 years, it's become quite large in the index. And remember, we are alpha generators, meaning we're cognizant of the benchmark from a performance perspective. So we need to hold a fair amount of gold in the portfolio to express an overweight in gold. You'd have to hold north of 22%. So you're holding about a quarter to a fifth of your whole portfolio in one very cyclical component. Platinum is a lot smaller in the benchmark at the moment, so we can hold a much, much bigger position in the equity fund. So the Fairtree equity fund that Cornelius and I, Jacques and Corb all manage, we have quite a significant overweight in platinum. So we think the trade is still there. We've used gold to fund some other opportunity sets, but what's driving gold, what's driving platinum, what's driving metal, specifically your base and precious metals, I don't think dissipates in the near term. Sorry, another consideration before I move on is the comment that I made earlier about the multipolar and the breaking up of the world. You're going to see a continuation of that dominance for metal, and it's not going to be all metals. We're not calling for a bulk commodity explosion like we saw from 08 to 2000, from 00 to 2008, where that was very industrial, it's lots of buildings and the likes, infrastructure type of build. This is very specific. It's defense and it's AI. And unfortunately, from an AI perspective, no matter how expensive it gets, specifically from a US perspective, you've got a carrot and a stick scenario. From a carrot perspective, you've got Elon Musk running around and saying it's going to make everyone very efficient, and every second person is going to be a billionaire. We need to invest in it. From a stick perspective, you've got China breathing down the US's neck and saying, we're going to win the race before you. So I see this to continue, even if you get into that point where the commodities don't become very sensical from a price perspective. So I think there's a lot of support for precious metals and base metals. And when I say base metals, I mean your likes of aluminium, copper, zinc, nickel. I see a continuation of support for that.
That's fascinating. I just heard this morning from Bloomberg, the Central Bank of Poland has been one of the biggest buyers of gold in the last sort of month or so. So a lot of central banks following that trend that you just described.
And I think individuals in their own capacity, if you look at the trends in China, there's a lot of individuals that are pivoting and just going into alternative assets.
Do you think there's any play for silver as an industrial asset and also precious metal?
Yeah, I mean, silver is an interesting one because the actual physical market of silver is dwarfed by the gold market, and the gold market itself isn't actually that big. So silver is a small market, and remember, it's not a pure play. You get very, very, very few pure play silver mines, if any. It's always a byproduct of something, of gold, of copper. So if the market wants to respond, it's not like they can just dig up a big, ore of silver. It means they've still got to produce the other commodities. So it could stay tight for a period of time. And also, 100 years ago, silver was very much a precious metal. Now it's very much used in industrial applications. So there's a lot of silver that goes into solar panels, for example. So as long as if we still continue to build out renewable energy, for example, there is still a support system for silver.
Okay, so we've seen 2025 as a very concentrated market in SA, although the absolute returns has been incredible. Do you view the SA market as cheap, or do you think there's some opportunity to have?
I think it's cheap, but I do think we have efficiency in markets, and sometimes I think it's cheap for good reasons. So if you look on your left-hand side, we're looking at price to book. It's just a metric. You can use any metric you want to, EV, EBITDA, PE. But you're looking across your insurers, your industrials, and your banks. Now, the strength we saw last year across your banks, your industrials, and your insurance companies is a tiny little blip. You can still see it's far off its history. And you would have seen also with falling interest rates last year, the banks responded to that, the insurance segment responded to it, property also responded to it. Retail did nothing. Retail was one of the worst performing sectors across most of the world last year. I'm talking about South African retail. You can see that on the right-hand side. So it hasn't responded the way it should. Yes, it's cheap. It's cheap on every metric, but no one has been spending. So when I say spending on discretionary retail, and we've been scratching our heads because we don't consider ourselves the smartest people, but we use common sense. At the beginning of last year, you start the year and you say, I'm going into a marginally better year. It should be a little bit better from a power perspective. Maybe Transnet improves somewhat. We have oil going sideways, meaning terms of trade are strong, meaning the rand is strong. Interest rate cuts. Surely the first thing you do is you run out and you spend it on discretionary. And we saw that come through in vehicle spend. Vehicle spend was very, very strong in South Africa last year, specifically passenger vehicles. We saw the banks recover. We saw lending have a little bit of a hype, also in corporate lending for the first time in some time. But we didn't see the response in retail. So the humans were not necessarily going out there into your traditional retailers and spending money. There are some structural issues across food retailers. We've seen Shoprite be the winner, and they've been investing and they've been innovating at the cost of a Spar and Pick n Pay, which have lagged considerably. And then in the fashion space, them just struggling. I mean, Temu and Shein coming in, then all the talk on online gambling, which we're still scratching our heads on. So we have pivoted, we've rotated. Mr. Price also took a bit of a knock with their Germany NKD announcement last year. So we have been nibbling at that. But I think you still need to see structural growth come through the system, proper GDP growth for our domestic counters to really kick during the course of this year.
Thank you, Chantal. Jacobus, let's move a bit more to the currency side of things. The rand showed strong appreciation last year, and there were a few factors that actually underpinned this move. Can you maybe describe these factors, and do you see it continuing in 2026?
Yeah, Stefan, if there was a currency World Cup last year and all the teams that normally compete in the Rugby World Cup competed in that, we would have won, so there's another cup for us. Look, the rand has appreciated, but alongside other emerging markets as well. They're just not playing rugby. They've done well, 13% as you've said. The drivers to those has been the dollar has weakened, and we believe will continue to weaken, as I described earlier. Flows out of the US, fundamentals, deteriorating. The twin deficit requires inflows to come into the country, and we're seeing some of those flows are being diverted somewhere else in the world. We think that the Fed will cut more than still other central banks. That will push down the value of the dollar, which is also overvalued. The second fundamental is there's a demand for emerging market assets. We see flows into the EM space, EM ETFs. because of valuations, attractive real yields. And then the third thing is just on the local side, we've seen an improvement in fundamentals, whether it is the country's risk premium that's coming down, better growth dynamics coming through, foreigners as coming to the country from a bond perspective, now also on an equity side. So I think these fundamentals mean that the rand could be well supported and be stronger. Last year, only like a month ago, end of last year, I thought I was brave by saying the rand's going to go under 16. Now we are at 16 at the moment. So, and I looked yesterday, if you look at the Nenegate and the COVID spikes that you had in the rand after that moved down, so appreciated 5 big points. So from 19 to 14 and from I think 17 to 12. We forget how much the rand can move when the fundamentals are starting to improve and when some of that risk comes out of the market. So I remain constructive of the rand because of those three drivers.
Cornelius, from a fund management perspective, do you think it's a good time to externalize money with the rand strengthening? And do you actually hedge the currency in your global funds?
I take a bit of a non-conventional view on this and tell investors not to overthink the currency when making offshore investment decisions. Because if you look at the move of the currency in blue versus the equity returns that you get, the equity returns always trumps the rand's move. And that is because the rand is one of the most liquid EM currencies. So people want to express a view on emerging market risk, and then they buy or they sell the rand, and then the equities tend to move in the opposite direction. But the equity move is always bigger. But as Jacobus pointed out, the rand can probably strengthen a bit further from here, but taking rands out at 16 is a much better level than what we were when we were very oversold at 19. And in terms of hedging in our funds, we don't use hedging in the EM or the global fund. We invest in companies that have the ability to pass on pricing ahead of inflation, because that will mean their earnings grows in dollars or any hard currency of your choice. And therefore, the share price will over time give you positive hard currency returns. If you decide to do hedging, you're anyway going to lock in some weakness if you're trying to hedge the lira in Turkey, for example. So we just try to invest in good companies that can grow ahead of any CPI or currency weakness.
That quality style of yours, how has it worked in emerging markets, given that emerging markets has given us 33% in USD terms? Is it too late to invest in emerging markets, or do you see this continuing in 2026?
Hell no. I'm wearing my green jacket to show I'm bullish on emerging markets and global equity markets. The nice thing about the Fairtree Emerging Market Fund, it's very diversified across the country exposure, where if you invest in most global funds, you get more than 50% US exposure. So there's so many different drivers in emerging markets. And Jacobus has unpacked the dollar that will likely still weaken going forward. And there's a very strong correlation when we compare emerging market performance versus the MSCI ACWI performance. And if you can maybe bring up that next slide, you can see the dollar has only started to weaken, and that has coincided with emerging markets starting to outperform MSCI ACWI. And we are talking about massive long-term moves. And then there's a lot of different things to be bullish about emerging markets. You have interest rates coming down. Real rates will come down in countries like Brazil. It's still north of 10%. In Turkey, it's around 8%. And we saw the benefit to equity markets and our bond returns last year as the global investors reassessed South Africa's risk, and we saw our credit rating upgrade for the first time. We also have massive divergence in emerging market country performance. Every year, there's a 50% gap between the top performing and the underperforming markets at a minimum. Last year, we had Korea up 100%. India barely gave you a return. The fund benefited from an overweight in Korea because we like the tech exposure. We like the reforms that's taking place in that country. and India's starting valuations were very steep. So we had a big underweight India, overweight China and Korea, and now we've started rotating that into other markets. We also overweight South Africa, by the way, last year. So there's a lot of reasons. Example, the strong commodities, which will benefit emerging markets. But if you actually look at the index composition, you get a lot of growth and tech exposure in emerging markets. The tech and growth exposure in emerging markets these days are actually more than what you get in developed markets, if you look at the next slide. And your starting valuations are lower, much lower in emerging markets versus the S&P or MSCI ACWI. So we think you get very nice index exposure in terms of sectors. You have favorable top-down dynamics with interest rates coming down and strong commodities. The currencies are still very undervalued versus the US, and your starting valuations are much more favorable. And you're seeing all these positive corporate governance reforms and shareholder-friendly actions being forced onto the companies these days. So over the last 2 years, we've seen the Value Up and Boost program in Korea. We've seen the 9 measures announcement in China. They are actually threatening directors and management teams with jail time if they don't start running these companies for shareholders. In the past, you've had very low return on equity in some of these markets and very muted earnings growth. But now they are telling companies to improve returns, improve dividends and buybacks, because these countries are sitting with aging populations. So historically, they wanted companies to invest and employ people and grow the economy. But now people are retiring and they need a return on the investments. And especially in a country like China, you're not going to get your returns on your property. So they need healthy equity markets. And that is a big shift that has happened over the last 2 years that is making us increasingly bullish on emerging markets.
Cornelius, that is fascinating. And it seems to actually pay to be an active manager in emerging markets. Give us just a brief description of how investors can actually get access to your emerging market and global equity fund.
Yes, I wouldn't judge people for having a passive allocation in developed markets, because it's very efficiently run companies. But in EM, I will judge you if you don't choose an active manager. There's a lot of opportunities for active managers to move between countries, and you have to move quickly. You can access the emerging market fund via our South African-based feeder fund, and then we launched our Irish domiciled, the ICAV, in December last year. So now you can access our emerging market fund in dollars or in rands. It's the same as you can do with our global equity. There's also a feeder option as well as an ICAV option.
Let's move to multi-asset portfolios, Jacobus. How are you positioned in your balance fund to actually capture these opportunities in emerging markets?
Right, Stefan. So I think, first of all, so the balance fund had a very good year last year. And I think part of that was because from the strategic asset allocation perspective, so from the starting point, we have more towards local assets than global assets, which has outperformed. And then within global, we have overweight emerging markets relative to developed markets. So I think that dynamic worked well from a tactical perspective. But even from the starting point, the strategic asset allocation, we have a higher allocation towards local assets. You also get some of that through the fact that we've been overweight South African bonds, that has participated in this emerging market fixed income local rally. Last year delivered 24%. And then also we were overweight commodities. We are keeping most of those the same, in the way that we feel still that you want to be on the offense, looking for opportunities in the local space and within emerging markets. And we are more on the defense, a bit more cautious in the developed markets. So we continue to be underweight the developed markets relative to local and emerging markets.
Thank you, Koos. Chantal, you and Cornelius manage the Fairtree Equity Fund, which was usually known as the Blended Equity Fund. From a fund allocation split, how has your global and local allocation changed over the last 12 months?
So maybe just to recap, Stefan, of that fund, it's a fantastic fund. It's a 60% local equity, 40% offshore equity. But what makes it unique versus some other houses is it's not building blocks. So it's not just plugging into the South African Equity Fund and the DM Equity Fund that Cornelius's team manages. It's best of breed. So it's great ideas from both, and then we pull them together. We normally have that 60-40 split. Currently, we're running it at 65-35%, and that's just because you would have heard through what Cornelius was saying, a little bit of a preference for emerging markets to fare better versus developed markets this year. Got nice opportunities within the local space. I think that Cornelius spoke through, I mean, I think their key pivot has really been away from some of the Chinese e-commerce businesses who are facing fierce competition through food and e-commerce, pivoting it into some of those US tech companies that have pulled back but are still high cash generators. So I think that's been a big tweak on that side. On the local side, we built quite a strong PGM position during the course of last year. So we're currently sitting at about 8 to 9% overweight in PGM space. And what's great about this fund is we're incredibly nimble. So we respond very quickly to opportunity sets. I mean, we're all spending so much time looking at the macro and trying to understand the big trends, and then we can respond quite quickly. Another really nice thing about this fund is you're not limited by the JSE options. So if we have an incredibly strong view on base metals or precious metals, like I said, and we want to express it a little bit more, we don't have to just play in the JSE options. We can buy Fresnillo, for example, which is a pure play silver company. Or we can buy a pure play copper company. So it just gives you a lot more optionality, especially if you've got high conviction from a macro perspective. And we found in years where you have high conviction macro, top down, and then you select properly bottom up, you get incredibly explosive alpha. And we keep measuring it. And thus far, we've outperformed the sum of the parts. So if you just carved out the two existing products and kind of stand them together, this product still outperforms it.
I hear diversification. That is the big key in this fund, obviously.
Definitely.
Maybe let's move it a bit more local, a little bit more boring. One retailer you think can maybe outshine the rest? And what would be the catalyst for that retailer to actually perform?
Oh, why did you choose retail?
I had to dim it down a bit. Otherwise, equities just outshine fixed income or any other asset classes.
I was hoping you're going to choose insurance or banks rather. Okay, so retail, let's be very unemotional about it. Okay, there is a lot of value, but part of our process is to not get stuck into value trap. So when we look at a sector of stock and it screens as value, the first question we ask ourselves is, how will this value be unlocked? It's either internally or it's externally. Internally would be a Pick n Pay, for example. So you have a bashed up company, a lot of leverage, their wholesale business is not doing well, and you have a Sean Summers that comes back into the helm and he magically fixes everything. He sells off the bad parts of the business. He IPOs Boxer, he realizes some value, and he does the hard decisions, basically. It normally comes at a bit of a cost. You get a bit of a staff churn, but in 18 to 24 months, the business is in a better position to perform. An external value unlock would be suddenly GDP in South Africa kicks 3-4%, and then all your boats are going to rise. So in that type of growth environment, you don't actually have to be too smart. Everything is going to fare quite well. I think Mr. Price is one that has been very bashed up. It's a high quality company. Historically, it's always had a good track record of capital allocation, and it's cash is king. You know, if you're looking for cash generation, this is a very cash generative company. It made a deal or announced a deal last year to buy a retailer in Germany, and the market completely punished it. So it was about 20% of its market cap. That's the cost of the investment or the M&A activity. And the market is has just cut that off. So it's priced this deal at 0. So if they actually get this deal right, you've got a lot of optionality. Plus, it's not taking away from the existing business, which is still a fantastic business. That's probably one that I'd choose, and that's just because I follow cash. The likes of a true Foschini is also pulled back, but it's not a very cash generative company. So you might get a dividend yield, but its bottom line often is quite difficult to get through. So I would probably go with a Mr. Price, and that's based on high quality company, potential value unlock. If GDP does kick, if Koos is correct on all of his positive sentiments in the country, with the rand being stronger, interest rates coming down, more and more reforms, rating agencies looking at us faring a little bit better, then all the boats will rise, and there's a lot of optionality across retail.
Thank you, Chantal. Given that monetary policy has dominated the last 15 years of global markets, Koos, give us a bit of your insights around the exceptional returns we saw from SA bonds last year, and what is your expectations from fixed income in 2026?
Well, I think last year was very much dominated locally by the reduction in the inflation target and bringing that down. I think that's caused or played part in a structural change in the fixed income space. And so a lot of the, I think, easy returns now has been made. A lot of positive news has been priced into the market. The starting valuation this year is probably fair to slightly expensive, but the drivers are still there. Maybe in a lower gear, but they're still there. We're still going to see inflation potentially coming down, inflation expectations falling over. The central bank continue to cut interest rates, fiscal consolidation, provide support, and the budget, which we'll see next month, may not surprise as much as it did in the previous one. But I think you will still see a primary surplus. Debt to GDP levels looks to stabilize. And in 12, 24 months, we are gradually potentially moving towards investment grade, gradually. So I think the returns over the next few years is probably going to be closer to low double-digit returns rather than what we've seen before. In the global space, yield curves remain steep as central banks continue to cut on the one side, and there's still concerns on the fiscal front and maybe inflation on the back end of the curve. But in the UK, rates can certainly come down. In the US, slightly at the front end. In Europe, the fiscal push for spending on infrastructure and defense could actually keep rates at the belly to back end a little bit higher. So a lot of different potential plays that could happen in the global space. But locally, not as positive as last year, but certainly more neutral in the local fixed income space.
Thank you, Koos. I think we've heard a lot about your macro outlook, just the big themes around what's going to drive the macro market in 2026. We've heard from Cornelius around his positioning on the global and EM side, as well as from Chantal around the local market, the exciting opportunities she's seeing. And the fixed income market, obviously, always a market that we underestimate. Last year, we've seen those brilliant returns. We've heard about what is your view on currencies. Maybe just, Chantal, last question before we jump into a Q&A. Your view on how commodities, especially oil and precious metals, play into the Fairtree SA Equity and Equity Fund.
So I'll separate them a little bit, but I mean, there's very similar views, I suppose, on precious metals, specifically platinum. I think if we continue into this 2026 with flat to sideways type of oil, it's going to benefit us. We don't have a lot of exposure to oil in the SA Equity Fund. There's a bit of Sasol for optionality. I think there's probably a little bit of, not much more downside to oil, maybe a bit of upside, and you can play that as a trade. MTN would also fit into there because often they're a little bit leveraged to oil as a play. But if platinum does well this year, I think that's where we'll get our explosive alpha generation from. We have gold exposure, but like I said to you, it's a tough one because it's so big in the benchmark that to express a significant overweight, if you want a meaningful 7-9% type of overweight, then you've got to hold a massive chunk of your portfolio in a very cyclical part of the market, which comes with a lot of risk. If we are wrong, and I need to caveat this, so say we're wrong, say, there's world peace tomorrow and everything abates and everything's hunky-dory and we go back to the old world order. Russia goes out of Ukraine, there's no more tension in the Middle East. Trump calms down quite a lot and everything just goes back to where it should, which is not my base case. We can move quickly. We can move quite quickly in both funds, and that's because we always play in the liquid part of the market. So if we've got the call wrong, we can rotate quite quickly. If suddenly SA Inc., the domestic part, that's the part that you want to be in, we'll quickly sell off and fund a lot of that positioning from our precious metal position.
Thank you, Chantal. We want to thank the viewers for staying on for a bit longer. We're going to move into a bit of a Q&A, a rapid Q&A. Koos, I'm going to start with you. SA equity and EM equity, likely strong performers. What other asset classes do you actually see outperforming in 2026?
So commodities did well last year and is likely going to do well this year again. But from a risk-adjusted perspective, I still think SA equities and emerging markets, is the proper call in this environment. As I said right at the beginning, there is tailwinds to this first half of this year, and maybe those tailwinds dissipate slightly later this year. But, we're in the upcycle. You want to continue to have exposure towards those risky asset classes.
Cornelius, single under-owned country or sector for the next 5 years, you will place your hat on?
We like Brazil. As I said, their real rates are north of 10%, and that means equities are also trading at very depressed valuation. So we are getting companies there trading on 5 to 10 times price earnings, but they're giving you double-digit earnings growth. And we saw how powerful rates and bond yields coming down South Africa was last year for the market. So we've tilted towards Brazil. And then if I can cop out and add another one, Kazakhstan has hiked interest rates throughout last year because their inflation was very high and sticky. So they've gone in the opposite direction to the rest of the world. But we are seeing inflation coming down closer to target. So they will start cutting rates. And I think like Brazil, but just a little bit later, that will benefit some of our holdings.
Chantal, outside of precious metals, which parts of the SA market are likely to drive alpha this year?
So I think, you normally divvy it up, SA Inc., metals in totality, and then your offshore defensive. I think they will continue to do well offshore defensive, but a lot of local managers have used as funding. So that's kind of not done exceptionally well, just purely because of that fact. Within resources, base metals could continue to do well. So that's not precious metals. The complexity is it's very difficult to get a pure play base metal play. You've got Glencore, you've got ARI, you've got Anglo PLC, you've got South32, and those will have some energy components to it. They'll have bulk metals, but I think those could continue. I think metals in totality could do well. The two parts of resources that I think could lag is paper and packaging, and we've seen that continue through Mondi, as well as oil and gas. So I think those will track sideways. In the SA Inc. components, I think short-term insurance is going to do very well this year, specifically OUTsurance. I think that the earnings are coming off a lower base. They should do well. You've got about 4% dividend yield as an insurance policy, no pun intended. And also you've got short-term guys do really well in a strong rand environment because they import a lot of their parts, so they benefit from that FX translation. And then vehicle sales have been very strong, and these are new vehicle sales, not used. So most of these players will be taking on finance. So I'd play the short-term insurance space. What I like is OUTsurance, and then as well as Sanlam, because you obviously get the Santam optionality through that.
Thank you, Chantal. Koos, maybe a question for you. What do you think will be the effect of the immigration and customs enforcement in the US in terms of internal politics? And what will be the impact on financial markets?
Right. So I think some of that we've seen already. So from a structural perspective, what you've seen is less people coming into the workforce in the US. Actually, some people may be leaving the workforce in the US. And as a result, as less people coming into the workforce, you need to create less jobs to keep the unemployment rate the same. So one reason why we've seen the jobs market being actually fairly soft, but growth continue to remain fairly high, is the fact that you don't need as much jobs to create as much jobs to keep the unemployment rate the same. Now, it doesn't mean that that's necessarily good for the economy because more jobs means more income, it means more spending. So we think that, this is not a sustainable phenomenon necessarily, that over time it could potentially start to impact overall spend. For now, spend has been held up because the consumer feels wealthy, their 401ks has gone up, their housing prices have gone up more than 60% since the pandemic. Specifically, those high income consumers, they've done well. So that's the one impact. The other one is that, so from a growth perspective, it could also, bring down the consumption. The other one is what we're seeing right now playing out at the moment, the political tension building up because of these actions. And we are getting more, I would say, pushback from within the Republican Party against some of the Trump administration's actions which are using, and that could have an impact in the midterm elections later this year. It could set up an environment where certainly the House is going to the Democrats. Maybe the Senate becomes more at risk. So the control of Congress is probably going to be split more evenly after the midterm elections later this year.
Let's take this a bit away from politics and geopolitics. Cornelius, what is the overlap between your global equity and EM fund? Percentage of assets that are actually the same.
So the Global Equity Fund is not a developed market fund. It can invest in emerging markets, but per the UCITS rules, we are capped at 20% exposure. So that is the max overlap that we can have. We are constructive on emerging markets. It's 11% in the benchmark, so we are sitting at 15 to 18% over the last few months. So the overlap, the names won't exactly match up necessarily. So in terms of exact match, the overlaps maybe 12%, but yeah, between 15 and 20 for the last year, we've been running EM.
Okay, one structural tailwind that's overhyped about India.
I'm not sure what tailwind is overhyped, but the reality is it is the one big market in emerging markets with positive demographics. And they are still quite a poor nation if you look at GDP per capita. So consumption growth will be very strong over the next few decades. But we are seeing that optimism being priced into sell-side estimates. And last year, estimates for consumer-facing companies for their earnings came down by 20%. And your ratings also reflect that there's a lot of future growth that people are already paying up for. So, we just think we understand the attractiveness of the market long term on a GDP basis and earnings basis, but you need to be wary of what you pay because that is ultimately what's going to determine your returns.
Thank you, Cornelius. Maybe one last question for Chantal. Maybe a different opinion. One of our audience members believes that Donald Trump is actually a good president and is good for the world. Is there any good that can come from any of Trump's policies?
Oh.
Difficult and heavy question to finish with.
Session recorded. Sure. I think that I've said this before. I think that what he's doing is good for America because I think that they do need to be stronger. There is, like I stated, there's a change in the world order. And if they sit back on their laurels, they won't be the hegemon of the world in the next 5 to 10 years. From an advancement perspective, from a technological perspective, from an economic perspective, I just think that his approach is probably not the American way. I think we've gotten used to America that is more influential, as opposed to being a bit of a bully and weaponizing things. We haven't been living in an era where the dollar's been weaponized, where their military's actually been weaponized. So I think it's casting a different feel. I think that they do need their allies. So I think that, and I think they need strong allies. So maybe he's waking up NATO a little bit. Maybe he's shaking up the Eurozone a little bit, because it's something we actually haven't chatted about. We've kind of left out the UK. We've chatted a lot about emerging markets, but we haven't mentioned UK and the Eurozone. And it is one area that I am concerned about. So maybe a positive from all of this is that they get a bit of a wake-up call and realize that they need to make some changes. They need to start thinking a little bit more strategically and a little bit more collectively. So maybe that's a positive that comes out of Donald Trump himself.
Thank you.
That's something.
Please, Cornelius, jump in.
I think he's bringing a lot more balance to different economies around the world, because the trajectory we were on, where China is just investing in manufacturing capacity and they're sitting with excess capacity, which depresses prices, and the rest of the world's manufacturing industry is being gutted. US standing up for themselves will force Europe to also do that, and they need to create more jobs. And it forces China to move to a more balanced economy, where they're going to push the consumer to consume more and become more a domestic economy, because it's not sustainable for the China economy to produce everything and America or the rest of the world to consume everything. The economies needs to rebalance somewhat. So I think for long-term stability, it's actually a good thing that is shaking the cage a bit.
Thank you, Cornelius, for balancing that view. I think we've probably reached the end of our conversation today. If there's any other questions from the audience, please send it through. We will try and answer it and send through the whole presentation as well as the recording. Chantal, Jacobus, Cornelius, thank you for spending time with me this morning and sharing your views. We are looking forward to 2026 as a year that might bring more uncertainty, but hopefully some great returns. Thank you, everyone.